You walk into your local branch, hand over a crisp $100 bill, and watch the teller slide it across the counter. You grab your receipt and walk out, confident your money is secure. We naturally assume that cash goes straight to a back room, sitting untouched behind a thick steel door until we need it again. But almost as soon as you step out of the building, the bank takes your exact deposit and hands it to someone else. This single loan effectively puts your cash back into circulation, creating new credit in the economy without ever touching a government printing press. If your specific bills are already in someone else's wallet, how can you go to an ATM tomorrow and withdraw your full balance without the whole system breaking down? These deposits function as the active, leveraged foundation of the entire global financial system. Look at this diagram showing how your initial $100 deposit splits apart. By law, the bank only has to keep a tiny fraction, say $10, in reserve. They immediately loan out the remaining $90. The person who borrowed that $90 uses it to buy something, and the seller takes that cash and deposits it into a completely different bank down the street. Now the second bank runs the exact same calculation. They lock away $9 in their vault and lend out the remaining $81. This sequence repeats endlessly. Each new loan becomes a new deposit, fracturing and expanding outward through the market. This mathematical cascade generates hundreds of dollars in new credit from that first deposit, fueling the economy through a compounding chain of debt. Economists call this mathematical loop fractional reserve banking. This constant recycling of cash is a deliberate design choice, built to solve a specific problem, making sure there is always enough capital available to borrow. This continuous lending cycle generates the massive pools of funds helping a local business expand, a family to buy a home, or a student to fund college. If banks had to hold every single physical dollar in a vault, borrowing would grind to a halt, severely restricting spending and slowing modern economic growth to a crawl. But this compounding math only works under one strict condition. The public has to maintain absolute confidence in the system. Because banks only hold a tiny fraction of total deposits, a massive problem arises if every customer decides to empty their accounts on the exact same afternoon. When that panic sets in, we get a bank run. The illusion shatters because the physical vaults mathematically cannot contain enough paper money to pay out the anxious crowds pushing against the doors. The precise mechanism designed to fuel rapid economic expansion also acts as a permanent, built-in vulnerability. To keep the system from tearing itself apart during a panic, governments created an institutional patch, central banks. In the United States, the Federal Reserve acts as the lender of last resort. When commercial banks run completely dry, the Fed steps in with the power to inject emergency liquidity. By ensuring local banks can honor sudden, massive withdrawals, these officials restore the public trust required to stop the panic and keep the cycle moving. The modern financial system operates as a continuous, fragile cycle of debt and trust.